Mainstreet Equity Corporation's Q3 podcast for 2025 is moderated by Gary Marr, President and CEO of the Canada West Foundation. A seasoned leader in government, business, and energy policy, he previously served as CEO of the Petroleum Services Association of Canada. Gary's extensive public service includes serving as an Alberta MLA, holding multiple cabinet positions, and representing Alberta internationally. First as a minister-councillor in Washington, D.C., then as Alberta's representative in Asia. Post-government, he advised on trans-Pacific trade and co-founded an oil trading company, linking Alberta producers with Chinese refineries. An adjunct professor at the University of Alberta and University of Calgary, Gary holds a law degree and practiced in Calgary before entering politics. In 2022, he was appointed chair of the Alberta Order of Excellence Council.
Hi, my name's Gary Marr, and welcome to the podcast for Q3. Let's get right into the numbers with Trina Cui, and we'll later on hear from Bob Dhillon.
Thank you, Gary. Thank you for joining us. So in Q3 of 2025, Mainstreet achieved the 15th consecutive quarter of double-digit year-over-year growth across major key metrics. For example, the overall rental revenue was up by 10%. Overall net operating income was up by 16%. On the same-store basis, same-store revenue was up by 6% and same-store NOI was up by 12%, although our vacancy rate has increased to 5% compared to 2.8% a year ago. It is mainly due to the acquisition of unstabilized assets happened in the last 12 months, and also some softened market in certain cities like Calgary. Meanwhile, as the rental market becoming more stabilized, Mainstreet remains strong given our affordable in-place rent of $1,250 range. As an overall result, our operating margin has significantly improved by 300 basis points on both overall basis and same-store basis. Funds from operation has increased by 10%. Funds from operation per share also increased by 10% to $2.61. So after 2 quarters of temporary pause on acquisition, we slowly restarted our acquisition activity. In Q3, Mainstreet entered into a brand new market right there by acquiring 182 units for $15 million or $85,000 per door. Subsequent to Q3, we are also in the process of acquiring 115 units over the province of Alberta and British Columbia. So as of the releasing date, Mainstreet is holding close to 18,800 units with the market value of $3.6 billion. Our liquidity position remains also very strong at $815 million, which is composed of $216 million cash on hand, $105 million estimate fund in Q4 2025, $365 million estimate fund that can be available through financing of clear title asset, and also $130 million line of credit. So as a strong believer of organic non-diluted growth and also value creator, together with the strong liquidity position, we believe the current operating environment, including the continued uncertainty from global trades, economic headwinds, and immigration policy, could accelerate Mainstreet's acquisition speed in 2025 and 2026, potentially paving the way for another phase of counter-cyclical growth at Mainstreet. So this is just a quick highlight of Q3.
Bob, I'm going to turn to you. I mean, you can't pick up a newspaper anywhere without reading about stories that rents are dropping, that the apartment building business is facing some headwinds. But the numbers that Trina just outlined for us suggest that you're defying gravity. Do you want to explain that?
Yeah, Gary. First of all, our business model is a lot different. We have mid-market, add value, Western Canada. Mid-market, 80% of the apartment buildings are smaller in size. Our average rental level is $1,250. Add value is a very widely defined terminology, but add value to us is we don't buy assets if we cannot reposition and increase our top-line revenue. And we are focused, no different than your Canada West Foundation. We are Western Canada, this side of the Great Lakes, which is Winnipeg West. Why is that important is most of the capital in the REIT market and institutional market is swimming around Ontario and Quebec. So if you take 80% of the pie, which is a mid-market, you take the add value, and then you take Western Canada, we are one of the prominent players in that segment. And so if we are adding value continuously, we are hitting double-digit returns because we are not financial engineers. We are value creators.
So you have to be looking at the numbers with respect to migration coming to Western Canada. What do you see as being the main drivers for why people are moving in this direction?
Before I answer this question, Gary, I want to finish the loop up on your first question. Why are the rents dropping? I think when you hear the headlines of Globe and Mail, it's referring to the brand new apartment units, which is not our segment. Brand new, these guys go out there and build these buildings, and they need $2,700 rents to make the numbers work. And they can get $2,700 rents because 60% of all Canadians make less than $50,000 a year. So they're not getting 27, so they drop in their rents. They say they drop at 10% or 20% with a high watermark of 2,700, and it drops down to 25, 23, 24, while we were last quarter 1,200, and we moved up to 1,250. Now, the second question is, why go west, young man? Is something I've been preaching for a decade or more, is affordability. We've had 10 years of inflation and not wage growth. So affordability has driven people to go everywhere but Ontario and Quebec and Vancouver, sorry.
So Trina, in her report, talked about acquiring more properties here in Alberta and a new marketplace in Red Deer. What do you see in Alberta and in particular, and what do you see in Red Deer?
Well, Alberta is a very unique market. First of all, as you know, the in-migration numbers are very strong. And even Calgary is getting expensive, so people are going to head now to Red Deer. And Red Deer is a microeconomic center that is going to continue to grow from natural gas to distribution, logistics, and they have a college there. And I'm big on international students and buying assets near colleges, universities, and growth cities. But another thing is we're also opportunist. This was a receivership deal that we bought in Red Deer, approximately 180 units at $85,000 a door. And why that's an important number on $85,000 a door, replacement cost is $400. Why that's an important segment of our conversation is new supply will not come till the rents go up considerably to justify new supply at $350,000 to $450,000 per door. So on risk management, if we continue to acquire assets at around $85,000 a door like we did in Red Deer, it's hard to get hurt. Even if the immigration to Alberta slows down and the oil prices drop, people need a place to live.
So if replacement cost is at $400,000, what kind of a rent do you need to be able to make that work?
The rent levels that you hear on Globe and Mail is my rents are dropping. So majority of the Canadians and international students and foreign workers and immigrants who come, they can't afford $2,700 rents. What they can afford is Mainstreet units. So that's why new supply is kind of restricted. And we're dealing with inflationary cost drivers on producing more units and cycle time with development permits and building permits. And now we got aging demographics where it's going to be hard to find plumbers and drywallers unless they change the immigration policies.
Trina's report, she talked about just under 19,000 units that you currently manage. I mean, what's the future for Mainstreet? Are you going to be growing that number? Are you going to be looking to expand in places that you're not at right now?
We have $815 million in liquidity right now. And let me give you a little history of Mainstreet. I know you know, but when we started Mainstreet, we had 8.9 million shares outstanding, and our asset base was approximately 17 million. And today we have 3.6 billion in assets, close to 19,000 units, 815 million in liquidity. and approximately annualizing Q3 would be $10 FFO per share. And we have 9.3 million shares outstanding. So we organically, non-dilutively grew our asset base to $3.6 billion through internally generated cash flow. So where does the future take? We had 22 geographic cities, and we will go with these counter-cyclical opportunity where we can add value. We're like an octopus. We have portfolios in Calgary, Edmonton, Regina, Saskatoon, Surrey, Abbotsford, Chilliwack, Kamloops, Vancouver Island, Victoria, Prince George, and I know I missed a few cities. Why that's important is we've got 20-odd geographic platforms where we have boots on the ground, an operational team where we can continue to acquire more assets without increasing a G&A. And one more thing, I see this as another counter-cyclical opportunity. While potentially the rates will drop, in-migration towards the West will continue, and hopefully they unleash the energy corridor. And if that all three happens, there'll be a new opportunistic cycle for Main Street while things are soft right now, which is counter-cyclical acquisition opportunity.
So in the past, you talk about counter-cyclical opportunities that would have included circumstances where in the past we've had low oil prices or we've had COVID or maybe the 2008 financial crisis. This time, what are the things that you're seeing that make this a counter-cyclical opportunity?
Let's talk about the history first so I can give a little color to our audience. 2008 financial crisis was financial crisis where market cap dropped significantly, so we used our balance sheet and cash flow to buy back significant part of our stock price, in which everybody was scared at that time and they thought it was a gutsy move, and it turned out to be amazing catalytic move that Bay Street is complementing for us even now. In 2014, it was low oil prices, and so we doubled down on Alberta and Saskatchewan. And then we had pipeline fiasco, ESG. Alberta became no-fly zone, and we doubled down in Alberta. COVID presented a different kind of opportunity. One was acquisition. Two was low interest rates, so we refinanced a balance sheet as low as 1.56% on a 10-year term. Now, the opportunity is psychological. We don't know what the tariffs are going to do to our economy. Federal government has shut down immigration, international students, and international workers. Things have slowed down. And it's created a big dark cloud on the future of Canada and the West. So I see this as an opportunity. If we didn't have $815 million in liquidity and we didn't have tremendous double-digit returns quarter after quarter, like Trina said, 15 straight quarters in a row, I would be in a different state of mind. I'm in the right phase to unleash our liquidity to go out there and double down. 42% of our net asset value is British Columbia. And we are in many great cities like Victoria, Surrey, Abbotsford, Chilliwack, New Westminster in BC. And BC is a kind of a soft market right now. So we are going to go out there and grow. We love the Saskatchewan market. Saskatchewan is an unsung hero of Canada. There's a lot of opportunities in Western Canada. We got the operating team, the liquidity, and the right geographic cities to expand on.
You know, in spite of all the volatility that you might read about in the newspapers, it sounds like this is quite different, that you would categorize this as a safe asset class. Would you agree with that?
There's a number of reasons. Number one, a decade ago, there was 2.2 million purpose-built apartment units in Canada from Prince Edward Island to Victoria. And the population grew by like 5 million people in the last decade. I think that's what the number is. Maybe it's higher than that. So the supply didn't go up and demand kept compounding. So that's how the supply-demand imbalance. Second factor is it trades below replacement costs because 60% of the Canadians can't afford $2,700 rents, which is what the developers need to create new product on affordable housing. So I've told you about demand and supply. So we had a unique cycle time to consider this a safe asset class for us to continue to expand and grow. One more factor is on the question of risk management on our asset class. Is AI going to replace affordable housing? So we had a unique business model, add value, cheap financing, and we were looking forward to another counter-cyclical opportunity to expand.
So you've seen these counter-cyclical opportunities in the past. You seem determined to sort of do it again, rinse and repeat. And you've got a cash flow model that appears to be different from other REITs that are out there. Do you want to explain that?
Sure. First of all, we are not a REIT. So REIT model is they have a different structure where they distribute most of their cash flow back to their shareholders. We take our cash flows, we reinvest in our buildings, improving the life of middle-class Canadians, take the cash flow to buy more assets. That's how we differ. And that's why we've organically, non-dilutively grown from 17 million to 3.6 billion in assets and $10 annualized FFO per share.
Wow, that is quite a story. That brings us to the end of our Q3 report. I want to thank Bob and Trina for being with me here today. I'm your moderator, Gary Marr, and we'll see you again sometime
Gary,
in the future.
before you go, is it possible that I'm dreaming that three things may happen in the next little while, and nobody knows how long, but next little while, and I need your input on it because that's going to affect value creation for the shareholders of Main Street. One, compounding wave, tsunami of people migrating to the West because of affordability, and Prime Minister Carney unleashing the energy corridor 2, and 3, the only lever government really has indirectly through central bank is dropping the interest rate. I know there's 3 different questions, but they're interconnected, and if all 3 things happen, I think the shareholders of Main Street would be very happy.
Here's what I think. I think that Canada needs more Western Canada, and the world needs more Canada. And that includes energy and agriculture. And in order to get our products to market, we need infrastructure. And the Prime Minister has placed a clear priority on export infrastructure. And that's really important because we rely, 2/3 of Canada's GDP is based on exports. And if you can't move it, you can't sell it. So the opportunities for Western Canada to provide the things that the world wants, whether it's potash, critical minerals, energy products, whether it's agriculture, agri-food, all of that relies on infrastructure. And I think that the Prime Minister understands that job one is that he's got to do things that are going to improve the economy of Canada, improve our productivity, improve our GDP per capita. So I think that I'm pretty bullish on what the opportunities are in Western Canada. I think that this part of the region of Canada will continue to grow, and it'll be of benefit to all of Canada if Western Canada succeeds. The path to prosperity comes through the West.
Second question, Gary. Do you lose any sleep on the tariffs that potentially may or may not be coming?
There's certainly a lot of uncertainty that's created by the tariffs, but so far it has been more threat than it has been actual implementation of tariffs. It remains to be seen whether or not the president continues. This is important for Canada because roughly 75% of our exports go to the United States. And there are some things that are tariffed now, but largely not things that come out of Western Canada. Energy and potash, as an example, is not subject to the same kind of tariffs that have been set on things like steel and aluminum. But I think that overall, the United States, regardless of what the president says, actually needs and wants the kinds of commodities that are being produced in Canada in general, and specifically in Western Canada. I believe that over the next few months, as people set their minds to legislators in Washington, D.C. set their minds to midterm elections that are coming up, I believe that always that self-interest will lead to self-correction, and that the tariff issue, while painful now, will mitigate itself over the period of time between now and the midterm elections coming up.
I may not get an opportunity to pin you down again, and as such a brilliant man with all this information you have. I have a last question. Dumb it down for me. What do you think the immigration policy is? Like, was it a clawback only for 2 years, or is it permanent? And there are 3 buckets of immigration that are important to the shareholders of Main Street. One is international students, one is international workers, and one is PR. I have little data on the PR, but I'm gray on the other 2.
I think that immigration has been used as a stimulus for our growth. If you have the right kind of immigration, you can actually stimulate growth in a way that is better than the manner in which it's been conducted really over the last 10 years. Making sure that we have the right kind of immigrants coming to Canada, we should be able to evaluate their credentials before they ever leave the country that they're coming from. And with respect to students, I think over time we'll see perhaps a relaxation of the restrictions on students coming in. And that is actually a huge opportunity, not just for rentals of student housing, but actually bringing people in that can go to school here and then participate fully in the economy once they've graduated. So I think that over the long run, there's been a strong pullback on immigration, but eventually it's, the idea that by the year 2100, we could have 100 million people in this country. Looking at it in the long term, I think that would be a positive thing.
And what's your view on PR? I read in Stats Canada, the first quarter of 2025, 100,000 people came. And why I bring that up is the brains at the C-suites in Ottawa must be saying we got aging demographics, and we don't want a knee-jerk reaction 5 years from now. Oops, who's going to pay for the CPP moving forward? What's your view on that?
Well, I think that, we do have to look at the demographics. Provinces like Alberta and Saskatchewan are relatively young, and as a consequence of having younger people, they're more productive in respect of the economy, and they spend more as young people than you do as you're older. And as a result of that, the provinces of Alberta and Saskatchewan are pretty strong, relatively speaking, to the rest of the country in terms of their provincial finances. And so I think that the federal government's got to be looking at this over a period of time, that the right kind of immigration, whether it's foreign workers or PRs or students, is going to be of benefit, but it's got to be in a way that's balanced. Make sure that, we actually have housing for such individuals. We've heard too many stories of people that have come here and decided that this is not the reputation that was given to them, and they've decided to go back to where they've come from. That's a terrible shame and a waste of resources for so many people.
And we have millions of people in the shadow market, and my numbers could be wrong, but this is my own case study and conjecture I put together. One last question, and we're going to sign off and enjoy this beautiful summer in Calgary, is if you're a betting guy in the next 6 to 12 months, what's going to happen to the interest rates?
That's probably an open question. Earlier today, the Bank of Canada indicated that they were holding firm, but the governor of the Bank of Canada had left open the possibility that interest rates could drop. So that's one of his options. It's one of the few tools that a central banker has. If I were betting, I would say it probably goes down over the next 6 months.
Thank you, Honorable Mar.
Thanks, Bob. Thanks, Trina. Appreciate being here.